Chapter 3, Learning Objective 1. Explain how the GAAP principles of timeliness, matching, and recognition require the recording of adjusting entries. Financial transactions occur continuously during an accounting period as part of the sequence of operating activities. If we look back at the work we've done so far with Big Dog Car Works, this sequence of operating activities takes the following form. First, operations begin with some cash. Next, the cash is used to purchase supplies and to pay expenses. Then revenue was earned as repair services are completed for customers, and finally, the cash is collected from customers later on. This cash-to-cash sequence of transactions is commonly referred to as the operating cycle and is illustrated in this diagram, which includes the activities from Big Dog starting with the cash on hand, which is used to purchase repair supplies and other expenses, followed by the performing of services for customers, which are collected later. Once the cash is collected, the operating cycle loop is closed and another cycle begins. Depending on the type of business, an operating cycle can vary in duration from short, such as a week for a grocery store, for example, to a much longer period, such as a year for a car dealership. Therefore, an annual accounting period can involve multiple operating cycles as shown here. Notice that not all of the operating cycles in the preceding figure are completed within the accounting period. In this case, the fiscal year from January 1st to December 31st. Since financial statements are prepared at specific time intervals to meet the GAAP requirements of timeliness, it's necessary to consider how to record and report transactions related to the accounting period's incomplete operating cycles. Two generally accepted accounting principles or accounting standard requirements, recognition and matching, provide some guidance in this area. The accounting standards provide guidance about when an economic activity should be recognized in the financial statements. An economic activity is recognized when it meets two criteria. One, it's probable that any future economic benefit associated with the item will flow to the business. And two, it has a value which can be reliably measured. Now, in the vast majority of transactions, these criteria are typically always met. Think about the purchase of a delivery vehicle for your business, where once you sign the paperwork, pay for the vehicle, and drive away, all of the economic benefits associated with the vehicle flow to your business and don't remain with the auto dealer anymore. And the value of the vehicle is easily and reliably measured by its published price. Revenue recognition is the process of recording revenue in the accounting period in which it was earned. Now, the important thing to note, however, is that this is not necessarily when cash is received, and quite often that's the case. Most corporations assume that revenue has been earned at an objectively determined point in the accounting cycle. For instance, it's often convenient to recognize revenue at the point when a sales invoice has been sent to a customer and the related goods have been received or the services performed. This point can occur before the receipt of cash from a customer, creating an asset called accounts receivable, and results in this journal entry, which includes a debit or increase to accounts receivable and a credit or increase to revenue. When the cash payment's received later, the accounts receivable asset is exchanged for the cash asset, and we have a journal entry where cash is debited or increased, and the accounts receivable is credited or decreased. Revenue is recognized in the first entry, with the credit to revenue, prior to the receipt of cash. The second entry has no effect on the revenue. When cash is received at the same time that revenue is recognized, we'll have a debit or increase to cash instead of accounts receivable, but still have the increase or credit to revenue. Now, what happens if your company receives a cash deposit or advance payment from a customer before the revenue is earned? Well, in this case, now we have a liability called unearned revenue, and this transaction is recorded with a debit or increase to cash and a credit or increase to unearned revenue. The advance payment would be a liability and not revenue because the work hasn't been done yet, and you would have an obligation to either complete the work as agreed or refund the advance payment back to the customer. This means that revenue is not recognized until the services have been performed. And at that time, this is the entry we'd make. We debit or decrease the unearned revenue and now credit or increase the revenue. The matching of revenue to a particular time period, regardless of when cash is received, is an example of what we call accrual accounting. Accrual accounting is the process of recognizing revenues when earned and expenses when incurred, regardless of when cash is exchanged. And this is one of the key principles of generally accepted accounting principles or accounting standards. Now let's consider how we recognize expenses. In a business, costs are incurred continuously. A cost is recorded as an asset if it will be incurred in producing revenue in future accounting periods. A cost is recorded as an expense if it's used or consumed during the current period to earn revenue. Introductory accounting students often get confused between when a cost outlay is an asset or an expense. Basically, cost outlays are recorded as assets when those costs are incurred to purchase something that contributes to producing revenue in future accounting periods. Examples might include prepaid rent, prepaid insurance, unused supplies, equipment, or vehicles. Cost outlays or expenditures are recorded as expenses when those costs are incurred to earn revenue in the present accounting period. So examples might include rent expense, insurance expense, office supplies expense, maintenance expense, or fuel expense for the vehicle. As with revenues, expenses can be incurred before, at the same time, or after cash is paid out. For example, consider the utilities expense for January that are not paid until February. Here, an accounts payable is created in January with a debit or increase to utilities expense and a credit or increase to accounts payable or utilities payable. The utilities expense is recorded on the January income statement, but won't come out of the company's bank account until the bill is paid in February via this journal entry. A debit or decrease to accounts or utilities payable, and a debit or decrease to cash. This entry has no effect on the expenses reported on the February income statement. Here's another example where salaries for January are paid on January 31st. The journal entry includes a debit or increase to salaries expense and a decrease or credit to cash. As a result of this entry, salaries expense is reported on the January income statement when the cash is paid. What about when a cash payment is made before the expense is incurred? For example, insurance paid in advance. A prepayment of insurance creates an asset called prepaid insurance and is recorded via a debit or increase to prepaid insurance and a credit or decrease to cash. The prepaid insurance is an asset because the benefits extend to future accounting periods. As the prepaid insurance is used, it's appropriate to report as an expense on the income statement by recording this entry, a debit or increase to insurance expense and a credit or decrease to the prepaid insurance. So these preceding examples illustrate how to match expenses to the appropriate accounting period. The matching principle requires that expenses be reported in the same period as the revenues they help generate. This means that expenses are reported on the income statement when the related revenue is recognized or during the appropriate time period regardless of when cash is paid. To ensure the recognition and matching of revenues and expenses to the correct accounting period, account balances must be reviewed and adjusted prior to the preparation of financial statements.